I'm Katie and welcome to another instalment of 5 and 5. With all the Brexit news and market turbulence, we thought it'd be a good time for Darren and Emma to answer 5 topical questions in 5 minutes. So, Darren, the big question, are we in recession?
I think that Western economies in general have been flirting with recession for the past decade or so. The reason for this is the fact that really we're over-leveraged. So there's a lot of debt in the system, and as a result, economies just can't grow like they used to be able to. The good news is that in the Far East and emerging markets, we're definitely seeing more room for growth. So that hasn't held portfolios back as much. I suppose here in the UK, what we might see now, because of the uncertainty that's been going on, we might see that actually instead of technically our economy growing by 0.5% this quarter, it might fall back to perhaps minus 0.5%. Actually, that's not a huge difference, but the media will probably seize upon that as a technical recession. And to that end, I think I'd encourage investors to just be able to look through that a little bit.
Okay, thank you. Okay, so Emma, in light of what Darren's just said, should I buy a second property right now?
Some investors may believe that real estate is the best option for them right now because it offers them a tangible and physical place to put their money. However, what we found from speaking to many of our clients is that property investment can introduce many problems. One of these being the additional stamp duty costs when buying a second property. Also, there are issues around income tax where a client may be pushed into the higher or additional rate tax bracket due to receiving rental income. Also, tenant issues and stricter landlord regulations make property investment less attractive. And also, investors should be aware of the potential capital gains liabilities and estate agent fees when selling the second property.
Thank you. And Darren, what are Thomas & Thomas doing right now to defend the portfolios?
Yeah, I think had you asked me that question a year ago, I'd have been quite concerned about the answer because usually the type of investments we've used within our portfolios would be bonds, so corporate bonds and government gilts. These are great defensive options which help to hold portfolios up when equity markets fall. So within our lower risk 1 and 2 and even 3 portfolios, we would normally use those. Now last year what we had going on was in the US really rampant growth and the worry of range of interest rate rises that were likely to come. Interest rate rises are a problem for bonds and therefore this was a worry for us. Now that things have slowed back a bit, actually those more cautious investments are starting to look more attractive again. We're not talking about double-digit returns, but what we are talking about is something that's going in the right direction at a time when equity markets have been struggling.
Okay, so on the subject of asset classes, what asset classes are doing well right now, Emma?
Well, last year we found that US funds were doing very well, while Asia and Emerging Markets Fund fell back. This year we found the opposite, so Asia and Emerging Market Funds are accelerating while US funds are struggling. And this is a good example of negative correlation actually. Also leading on from what Darren was saying, fixed interest securities and also property are doing what we would expect really. I mean, they're holding the portfolios up during equity crashes and volatile times. But as our clients know, we never choose one asset over the other because we believe in asset allocation and diversification, which is key to protecting portfolios.
Okay. So with markets looking so choppy at the moment, should I just hold cash and wait?
That's the age-old question, isn't it, really? I've always thought it's more about time in the market, not about timing the market. So you would be forgiven right now as an investor for thinking, oh my goodness, there's so much negativity out there. The press are just telling us that everything's terrible. What I'll do is I'll just take my money out of my portfolio and I'll hold on to it and I'll wait until the news is better and markets seem better and then I'll get back in again. The problem with that is you're almost certainly going to make a loss. And the reason is you'll take your money out when things have fallen, and then by the time you get back in, the markets will have already risen, because recovery, when it comes, and it will come, it could be next week, it could be next year, but when that recovery comes, it's rapid. It happens over a matter of days, not months. And to that end, I'm afraid you've really got to be in it to win it.
Okay. Thank you very much, Darren and Emma, and thank you most of all for watching this.